Group, David Stryzewski. Make sure my tongue works right today, David. How are you?
Hey, doing fantastic, John. How about yourself?
I'm doing great. I'm guessing I might, and you're probably a little better than a lot of people that have a lot of money invested in the stock market, because if that was you at today, it's not a great day, is it?
Well, the market goes up and down. So we need to have a healthy expectation that this is going to occur. But just like you said, John, this is a really, really, really bad day for people who did not have defensive strategies put inside of their portfolios, and they're just all in all the time right now, expecting that things are just going to be, peachy, and there's no such thing as a recession on the horizon. I think a lot of people right now are having their bell rung, a wake-up call going on, and, this is a moment to not be complacent. This is a moment to really be paying attention.
I got a couple of text messages early this morning saying, is it a bad day around the Rush House because, John has, X amount of money in the markets? And I'm like, yeah, no, it's never a bad day for the Rush House when these things happen, because, no, I don't have a lot of money in the markets for obvious reasons.
Mm-hmm. Well, and here's something that we say to families as well. The market goes up and down, period. What we want to do is we want to teach people how to ride bull markets and tame the effect of bear markets. So that's the name of my new book coming out, Riding Bulls and Taming Bears, Investing for Retirement in the 21st Century. And so, if we just follow typical 60-40 strategies and diversified strategies, John, you are absolutely right. I believe that it's going to leave most of America high and dry at a time when they really need these dollars to be there for them as they're retiring.
Absolutely. So and that's where, and to your point, David, you've got to be diversified. Now, there's a certain amount of people out there listening that, the way I always look at it is, if you can afford to lose it, fine, don't worry and don't whine then when there's days like today. On the same token, I think there's folks out there listening, David, that might benefit from, where's the bottom? That I don't have the answer to. That's why you're here, by the way. You're the expert on this. But there's also opportunities when these things happen.
Yeah, absolutely. So what we want to do is we need to understand, again, ride bulls, tame bears. There's opportunities, things ebb and flow. So we want to look at cash assets, protected assets, risk return assets, relative to your age, time that you're going to retire, et cetera. The right percentages are going to change. But to your point, this is the weakest strong economy I think I can remember. And
good way of putting it, by the way.
So you go, hey, where do we go right now? Where are some of the safety places? And one of the places I'm just going to mention, yes, oil definitely is going to work out. I believe metals and miners are definitely going to be working out.
And really quick, just stop you for a moment there, David. As we know, what you're just talking about there, those core things that we need as a country to survive, oil especially, it ain't going anywhere.
No, these companies are very profitable right now. So this is the thing, we got oil prices are going to be going up. A lot of what we're seeing right now in this turmoil is actually because of what's called the Japanese carry trade. And so that's a really complicated idea, but basically you could borrow money for cheap.
And really quick for everybody listening, because I think this has a lot to do with why. Not all, but there's some of what you're talking about in the Japanese market, and I watched it happening over the weekend, that had a big play on what happened today. For people listening, that's fascinating, by the way. Take a minute and explain that. Sure.
So, so Japan just hiked their rates. And so what we need to understand is that with bonds, which is what specifically is important to understand with rate changes, when rates go up, it's like a seesaw effect. The other side of the seesaw goes down. That is the asset that you held. It's worth less now because they're paying a new higher rate. But in Japan, people have been able to get a loan for like 0.4%, and then allocate into U.S. Treasuries and make some percentage more just by allocating to the United States. Well, what's happened now is with this rate change, this is causing the carry trade to unwind, and so people are losing money and not making any more money on this now. And so I think it caught institutional investors by surprise. And and going back to some of the challenges here, Japan has to import 100% of oil. Right. They have to import a lot of different things. These, just like you said, John, these are the things that are going to keep us in the future. Right. The stuff that we're actually going to be using, not some manipulated form of finance that, makes some people money sometimes and others not. This is going to come down to real things right now. So bonds lose money in 5 different ways. I think the sucker at the card table right now is the bond market, and it is literally 2 times larger than the entire stock market.
Wow. And really quick, going back to the Japanese thing, just to make sure everybody understands what was going on, it wasn't just U.S. dollars that people were buying. So people in Japan or even outside of Japan could actually go to Japan and borrow money for almost nothing. And make sure that I'm saying that correctly, because for the longest time, Japan had a negative interest rate, meaning you paid them to keep your money. So people like you and I, David, we could go to Japan and say, you know what, we want $1 million. We're going to borrow that from you. We can borrow it for like 0.5 point. Well, you and I, we could take that $1 million and go around the world and even just invest in other countries' economies, if you would. We could buy pretty much whatever we wanted to, bonds, as you're mentioning right now. We could borrow, we could borrow that money from Japan at almost nothing and go invest it someplace else and make 4%, let's say. Well, the reality is people were borrowing money to go make 4 points. Well, that all changed today.
Yeah, and that's why the Japanese market literally had its single largest intraday loss of 13.5%. So worst day in history. And now this has got everyone talking, the Fed needs to cut. They got to do it now. And they're talking about emergency sessions.
Oh, the Fed should have done that last Wednesday. Actually, they should have done it months ago, but they're knuckleheads and didn't.
Well, and you know what's funny? I've been saying that they should be cutting, but I didn't think that they were going to do it until we find ourselves in a critical moment.
Yep.
Like
they're always, just like they were late to the game raising them, they're now late to the game lowering them.
Bingo. You
and I have been talking about this for months, David. They should have been lowering rates the first quarter of this year and didn't.
Well, they were late to raise them. They were late to lower them. In my opinion, we are going to name this next recession the Federal Reserve bubble, because we have to assign the credit to the individuals who have caused it. They have manipulated markets. They've manipulated industries. It's been worldwide. And this whole thing is coming undone right now, which is super, super, super scary, especially because of the risks. So many boomers today are like, hey, I got to retire. I need this money.
Right.
We can't afford another 2008 in 2024, 2025. We need this now.
So when it comes to the bond market, as you said a moment ago, what do you think is going to happen there? I mean, where are the risks if folks have money there, and what should they do?
Okay, first thing is that when interest rates rise, and by the way, the United States, I believe, is going to probably have to raise rates here in the future, but that's going to come probably in about a year or two from now. So when rates rise, like we're seeing in Japan, that really hurts things. Next, we got credit crisis issues. If you go from being A-rated or even triple B and you go to double B, you have less credit. It costs you way more now to borrow. That's a really bad deal. The United States right now has been downgraded by 2 of the 3 major credit agencies. I believe Moody's is going to be showing up here at some point in time, because we're printing $1 trillion every 100 days today. And this isn't turning around. The only reason why the economy is moving forward is because of stimulation, quantitative easing, from the government. Mm-hmm. So unless it's stimulated, we got nothing. And these bonds are literally, in my opinion, weapons of mass destruction. If we find ourselves in a situation where credit's coming unwound, we're going to have more carry trade issues like this, and the United States begins to lose some of its power. And last point on that, John, is this: I believe that we're probably going to see ourselves here losing the world's reserve asset status on the Treasury of the United States. I realize this is not a popular idea to say out loud, but we will always be the world's reserve currency because people will use our currency. Yep. But the asset status, that's the part that is at risk right now. And I don't believe that we actually understand what that means or the implications.
You could be right. I mean, I've always said the USD will always be strong as long as I can take a $100 bill, and I can right now at this moment. Will that change in the future? Yep. It's hard to say. But if I can take the $100 bill anywhere in the world and buy something with it, which I can today, maybe there's 1 or 2 exceptions to that. But for the most part, even on the underground, David, you know as well as I can take a $100 bill and spend it pretty much anywhere in the world right now. If that ever changes, we're in trouble.
Absolutely. And, let's just even say that people are starting to buy gold and Bitcoin and silver right now. And so they go, hey, this is money that I want to hold on to for a long time. And they got U.S. dollars in their pocket. You're going to dump the U.S. dollars, which are liquid, easy to spend anywhere. And you're going to keep the stuff that you believe has the ability to go up with inflation and buy, more in the future, and is going to be the dollars you really want to hold on to. So I think that we're going to see a rotation into safer ideas right now. And the world is going to be paying attention. 60/40 has no allocation to gold or silver at all. That's a big deal.
Interesting. Okay. Well, and nobody has a crystal ball. I don't either. I do know, and you and I have talked about this multiple times. I've talked about it for a while now on this program. Anytime we talk finances about, what the Fed is doing, they have been misleading the public into thinking that the economy is better than it is. They're, in my opinion, the Fed is, in cahoots with the White House. I know they claim that they never are, but they definitely are this time around, I think, for sure, because they're telling everybody the economy is a lot better than it is. It's only good because of the things that you just mentioned a little bit ago. Good, I use that term loosely, by the way, David, because it's not good. I know what's going on the streets. I coach other businesses. Right. I know what people have as far as disposable income goes right now. They're not spending the same dollars they were a year ago. It's not as good as the White House or the Fed want you to think. Jobless claims, as we just saw this last week, are way up. It's easier right now as employers to actually hire workers. I'm seeing it. I'm seeing it happen right in front of our faces, David. The reality is the Fed is missing it. The question is, are they missing it because they're trying to help this White House keep things propped up to claim the economy is better than it actually is?
Yeah, or it's in part because pretty much there's a global recession that's on the verge right now. The entire banking system worldwide would be involved with this. And let's just say that they're trying to look like a duck. On the surface, everything's cool, calm, collected. Underneath, they're just paddling their legs as hard as they possibly can. But
why wouldn't you go ahead over the last couple of meetings, lower rates a quarter point each and get them down some to ease some of that burden on businesses, especially where you're now stimulating some spending and helping the economy out, which is exactly what happens when they do that. Why wouldn't you just do that, though, David?
So what they're doing by not lowering rates is they're trying to curb inflation. Inflation is actually way worse than they've been letting on. And so they're like, shoot, we got to get more inflation out of our system.
But don't they partially, and again, I'm a guy from the streets, don't they create inflation by keeping those rates up? In other words, as business owners, myself included, we have to compensate for that borrowing rate that most small businesses, medium-sized businesses, unless you're the Apples and Microsofts of the world, and you've got your own stash of cash, and even then they'll borrow money. But the reality is, the regular, medium, small businesses, they borrow, they have lines of credit, and so on. Those costs always get passed on to the end user. Isn't the Fed in a way creating inflation by keeping it, or by keeping rates up also?
John, you start to make sense when you start talking like that. The point is that if they drop rates, though, it's kind of a damned if you do, damned if you don't, because if they drop those rates, it's going to be very inflationary for the stock market. Everything's going to go wild and awesome. And then, but of course, the middle class is what's getting smoked right now.
Right. Credit card rates are in some cases 34%.
Right. Unbelievable.
35. And I'm not joking. I saw somebody post that the other day. It's 34% depending upon your credit and the card you have.
Wow.
That's unreal.
If you look at the economy right now, unemployment, those are going to part-time jobs. The jobs numbers that we're seeing are so grossly overstated. That's right. Now. I mean, just in 23, 730,000 jobs they overstated it by. Well, why didn't we correct on that? Because no one cares about the actual data. They just care about the headline.
That's right.
And the sugar high moment.
That's right.
So that type of investing is not fundamental. That's not long-term. That's not last. And so we need to understand there's a specific shift that's taking place right now in our economy. It's going to leave a lot of people high and dry.
Agreed.
They don't understand how to get in alignment with this.
So that's where you come into play. Sound Planning Group, your book. And I should ask, and I apologize. I should ask when we started off. When will that be out?
Yeah, John, it's been a little longer than expected here. So the goal is September, so I'm looking to do that. And people can keep putting their name in on the website there, the fedbubble.com, or myspg.com, and to get some basic. Well, you know what? I'm not going to be critical.
You're doing something I'll never ever do, and that's write a book. I mean, I should never say never, but yeah, that's not in my wheelhouse. So you're doing something that I admire people that do that. So. Best of luck to you, David. I understand how all those deadlines work and the printing press in and of itself and so on. I realize all of that. And in a lot of cases, you're at the mercy of others. So, no, I fully understand that, and I get where you're coming from.
Mm-hmm. Yeah. Hey, well, appreciate you. And, the goal here is to be able to shine light, share truth, and really help people to make a difference here because, unfortunately, most of the advice that's rendered today, in my belief, in my opinion, based upon how I see the world, it is a world that is changing, and these things are not going to hold water.
Agreed. Fully agree. David, how do they get a hold of you in the meantime? What are those websites again?
It is fedbubble.com. Remember, the Federal Reserve bubble is what's happening right now. So fedbubble.com, or they can give us a call at 425-821-9442. It's our main office number.
All right, I'll make sure we get the website in there for my notes a little later this evening when those go up on the website. David, as always, I appreciate you. And I reached out to you to get you on soon today because of what was happening. I appreciate your graciousness and agreeing to join us with really not a lot of time. So thank you for that also.
Honored to be with you, John. Thank you for your time here.
Always a joy, David. Appreciate it very much. Sound Planning Group, fedbubble.com is the website. K&R Home Transitions. And for a lot of you, your home is